This is Home Buying Basics, where we attempt to simplify the mortgage process of buying a home. I'm Azubuike with Edge Home Finance, and today we're going to talk about income, specifically debt to income ratio. Yes, we are going to attempt to make sense of all of that for you. So stay tuned, let's get it on. Okay, so we've got right here what I call my DTI calculator. Just so you guys know, I'm a Google Sheets nerd. I love Google Sheets. I use it for everything. So this is a breakdown of basically what every underwriter looks at in regards to figuring out how much you can qualify for with your income. So just to make sense of this for you, what we're looking at. So we've got a mortgage calculator here, this blue section. Under that is your income section and your monthly debt section. And ultimately, if you have more than the spaces here, you can put more debt to income or more debts lower here. But basically what debt to income ratio is just a relationship between your income and your debts. It's literally taking this number here, or if you end up having more debts, it'd be this number here, divided by your income. So that's how you see the 50%, right? 2,500 divided by 5,000 is 0.5 times 100 is 50%. So that's how you ultimately get your debt to income ratio. Now the front and the back end comes into play depending on the program you're dealing with. FHA a lot of times wants to see you under 41% front end and under 57% back end if you have scores over 640. But conventional, they don't really care about front end. They just want your back end being under 45%. So that's the ultimate number that we want to shoot for, is being under 45% back end debt to income ratio. Preferably, if you're under 45% back end, most programs, you're going to be good with that max debt to income ratio. And I'll explain the difference between front end and back end here in a little bit. But just to kind of break down this a little bit further, let's just do a little scenario. So we've got 400,000 as the purchase price, 5% is what we're looking at as the down payment. And basically you've got everything else that you see here in the mortgage calculator. Now, when you see a white box, this is something that I'll actually share. I'll put the link for this in the comments so that you can actually use this if you so choose. But you can come in here and make adjustments to this. Anything that's in the white box, you can actually make a change to, right? So if we wanted to go to 450, you see how it impacts our debt to income ratio on both front end and back end. So, let's touch on that real quick. Front end basically means it's the overall relationship of the housing expense divided by the total income. Back end is going to include all your debt payments that show up right here. Okay. So if we were to have, let's say, a $300 car payment on this scenario, it changes our total monthly obligations to this number here because it's adding this to the housing expense, and that's what adjusts the back end number. Okay, the front end stays the same, back end number moves with your credit report debts that you are obligated to. So that's the difference between front end and back end. So let's kind of make sense of this to where we can see a qualifying scenario, because again, we want to preferably be under 45%. And especially if you're doing a conventional loan. Ideally, you want to be under 45%. They will allow you to go up higher to 50% if you have what's called compensating factors. But for the sake of this video, let's just try to keep it simple and shoot for 45%. So basically what has to happen is if you have limited income, obviously income is the main driver. So if Mr. Borrower number one earns $5,000 a month, and this is based on his gross number, by the way. We always look at it monthly. We always look at gross if it's W-2, and then whatever's reported on tax returns if people are self-employed. But 5,000 is our number here. We want to get under 45%. So we're going to have to bring our price point down, right? We may need to go to 350. And that's what we have this DTI calculator for, this mortgage calculator for, to kind of help make sense of all of that. Now, there's obviously a few moving parts with the debt to income ratio as far as the mortgage calculator, because we have taxes in there, we have homeowners insurance in there, we have mortgage insurance if it applies. When you're doing conventional, you do 20% down, this goes away. Mortgage insurance is at 0, but less than 20% down on conventional is going to require mortgage insurance. So I included a link here because it's a nice little place that you can go on Google, and it gives you an idea of what the estimated mortgage insurance rate would be. Now, just know conventional is always going to have a variance with how mortgage insurance is calculated, because mortgage insurance with conventional is private. And so that means the mortgage insurance provider is going to price it accordingly to what their preferences are. But it should be pretty comparable, and that's why this link to Google should be helpful. If you're going FHA, you're going to have to make this change here. Mortgage insurance premium is always going to be added into the loan, and then the monthly insurance is always going to be 0.85% of the loan amount, the total loan amount. And that's what adjusts our number here. I'll zero that out real quick. So that's just the difference with FHA. And then obviously you can do a minimum of 3.5% down. So you're kind of seeing just me throwing in the numbers, how it's changing things here. So we always just want to make sure that we're including any debts that show up on credit, any car loans, student loans. So let's say this person has a $450 car loan. Let's say he's got, I don't know, $250 that's required for student loans, $35 credit card, and another $75 credit card. Okay, so he's got a total of, what's our number here? So a total of $810 additional to the housing expense. So that's going to adjust our front end debt to income ratio to the back end. Now we're over 61%. So for this person, if they're bringing in $5,000 a month, they're not going to qualify for this price point because of how high the debt to income ratio is. We need to get this number under 45% preferably, right? So what you can do is you can bring in a borrower. You can bring in a second borrower. They don't even have to occupy the home. If they're just a co-borrower that's willing to be on the loan, let's say he brings in his mom and she can show $3,500 a month. All of a sudden, look, our debt to income ratio is way better. Now, obviously, if you have another borrower in, we do have to include their debt. So let's say she's got a house payment of $1,200. So it pushes us back to 50%, right? So we have to just keep in mind all the debts, all the income, and in relation to the mortgage calculator that we're showing here, this is what gives us our debt to income ratio. And that's really as simple as it gets. I mean, hopefully that makes sense. I know it's not fully simple, but hopefully this helps simplify it. And again, this is something that you can save. I'm going to have a link on the comments below. If you want to check it out, definitely feel free to. And feel free to share it. Feel free to share it with your clients. If you're a real estate agent or a loan officer, feel free to share it. This is something I do with all my borrowers, and it really helps them kind of give a picture to what the numbers are doing and how they break down. I also forgot to mention this. I included a few links here. The mortgage insurance I talked about earlier. This is for the property taxes. And so this link, Smart Asset, it can actually show for any state. And it can give you an idea of what your annual property taxes will be. So you can put the estimated number for your situation here. So that's all I got. Hopefully that helps. Feel free to give me some feedback and comments. Let me know if it was helpful for you, and we'll hopefully keep the content moving forward, rolling. So thanks for tuning in, and we'll see you on the next video. Thanks for watching. If you found any of the content helpful, please subscribe, hit the notifications icon so that you can be informed of the next video upload. And if you're a borrower looking for a home loan, purchase, or refinance, I'd love the opportunity to work with you. Please give me a call or start the process at applywithzo.com.